And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. With turmoil in the markets, active management is again assuming an important role in the mutual fund and the ETF community. Let's talk about it with Brian Lake, the global head of ETF Solutions at JP Morgan, Dave Nautic, CIO and Director of Research of ETF Trends. Brian, you oversee the largest active fixed income ETF. That's the ultra short income ETF. Tell us why active management, in your opinion, is again becoming a big play in 2022.
Yeah, thanks, Bob. I think the key is it combines the best of both worlds. You've got the benefits of the ETF wrapper, trades throughout the day, tax efficient, transparent, with the intentionality of active management, a portfolio manager that knows exactly what they own, why they own it, when it goes into the portfolio. And as a lot of folks on this show have talked about in the past, or that are on CNBC all the time, talk about why they own things. And I think it's important that investors want to know why they own it. And so to have intentional investing from a portfolio manager, I think that's why active ETFs are having such a big year already in 2022.
Speaking of a lot of trading, Dave, I want your take here. I want to go back to the active trading part, but give us your take on the trading this week. I saw volume 4 or 5 times normal in some of the big exchange-traded funds like the S&P 500. That's trading, but what about flows? What did you see in terms of flows?
Yeah, well, the last 5 days have been great from an ETF flows perspective. We've had about $14 billion flow into equities. About 2/3 of that has been international. We've seen a lot of folks allocating into domestic, emerging, to emerging, to developed markets internationally. Europe has been getting a bit of a bid, but there's still been $4 or $5 billion in new flows into U.S. equities just in the last 5 trading sessions. So to me, that means that we've really had a raft of advisors and investors who've been looking to buy the dip here. We've seen no evidence that the ETF side of the balance sheet, if you will, is what's panicking and pushing the button to sell. If you look at things like the volume weighted average price, even in something like the Qs, there really hasn't been any volume at the tails. The volume has been very much right in the center of the trading where we'd expect. It hasn't been a lot of folks just using the ETF to whipsaw. It's been folks using the ETF to allocate.
And Dave, while we're on the subject, we were just chatting with Brian about active management. Do you think there is going to be significant upside for active management this year because of the market volatility? We've talked about this so many times, and it always essentially peters out. Indexing still wins out, but is this something different?
It is a little bit different. The last 3 or 4 years have been really different with active management coming in a big way. And it hasn't just been sort of short-term fixed income. With all due respect to JPSD, which is a great fund, we've seen active equity show up in a big way. We had about 13% of the flows last year come into active ETF. That was a big uptick from the sort of 11% we were seeing before. A great chart we've seen from FactSet. You guys just put it up there quickly. Those flows into active just continuing to come in year after year, increasing and increasing. I wouldn't be surprised to see a 15% year for active management this year. I think the volatility in the market is good, at least for the story of active management. Whether or not sort of traditional active stock picking equity managers are going to be able to outperform, that I remain skeptical of. But I think there's really a place for active management when folks are looking at the corners of their portfolios.
Yeah, I agree. It's good for the story of active management, for sure. Brian, there's also a lot of interest in products that enable you to stay in the stock market and still have downside protection. Now, you have the JP Morgan Equity Premium Income ETF. The symbol is JEPI. That's the fastest growing active equity ETF. You've got $6 billion in assets under management. What does that own, and how do you get this downside protection that is sort of a side aspect of this?
Yeah, I think it's a big part of it. It ties down to the point that Dave's making as well, which is when investors are using active ETFs, they're trying to achieve an outcome. If they're buying the ultra short, they're trying to step out of cash, maybe get a little bit of extra yield above and beyond, just what cash is giving you right now. Equity premium income, JEPI, is a great example of that as well. We all know that there's a lot of investors that want a lot of income. JEPI has a distributable 6 to 9% income stream that comes off that portfolio. So for investors that are looking for the outcome of income, that certainly checks the box there. And then because of the way that the strategy is set up, it should only have about 2/3 the risk of the S&P 500. And the way we're doing that, Bob, is we own a basket of quality securities, U.S. equities, and then we're writing out of the money calls on that, which allow us to collect that premium into the portfolio. And so investors have found that really can play a role in their portfolios to both achieve the income and to get some of that downside protection that you're talking about.
So it's a buy-right strategy, right? You're buying out of the money calls. You're writing out of the money calls, right?
That's right, but it's an active strategy, which I think is key. The underlying basket, there's fundamental research that goes into every single one of those stocks that we own, and then we have the portfolio manager that's writing the out of the money calls. To your point, that's doing that with intentionality as well. So it's not just a rigid process. Yeah.
And I'm looking at the top holdings here: DTE Energy, Microsoft, AbbVie, Progressive, Alphabet. This is quite a group here. Is there any rhyme or reason to the methodology for picking what's in this?
Yeah, well, I mean, we're doing bottoms up research there. So there's a fundamental analysis to that. We've got one of the best equity franchises on the street. And so we're doing the research on those individual names. We're looking to buy good quality names that can be a core of a portfolio.
Dave, talk to me about these downside protection products that are out there. Are they getting any more assets gathered?
Yeah.
And what are the risks of owning them?
They've been actually one of the big stories for the last 2 years. Last year, it was about 10% of the flows went into products with some sort of downside protection claim, at least. Whether they've been things like the covered call writing strategy on the income equities like JEPI, whether they've been other funds that are doing more collared strategies where they're actually buying puts off the bottom, creating so-called defined outcome tranches that you can expect your returns to be in. Those have been pulling in quite a bit of assets over the last 2 years, really. I expect those products are going to have done well when we look back here in a month or two. The kind of markets we've been have been the markets that are designed for those products, or rather those products are designed for. So I think they're going to have their moment in the sun here. I think that will draw additional assets. And frankly, you mentioned this is a way for people to stay invested. That's what it's done. It's allowed advisors and investors to stay in these equity markets as opposed to just going to cash and yielding a couple basis points.
Yeah, they make sense, and certainly in a downside situation, Brian. I always wonder about what happens when the market goes back to normal. You get outflows again from these kinds of strategies. You know, we all know the behavioral economics here. People panic and they think, I can't get out, but I need some protection, and so the money flows out if the market normalizes.
You know, I think what we're talking about, though, is that investors have more tools than ever to build the portfolios that they need. And if investors start with what am I trying to achieve here, and then look at the tools that are available to them to achieve those goals, they're going to do well. And so now they have more tools that can help them protect to the downside. And you know, those tools should do the job. And when the job's done, maybe they'll use another ETF that helps them accomplish something else. And you know, I think that's what's so exciting about being an investor right now.
I just want to move on and talk about there's a whole conversion process from mutual funds to ETFs again. And Brian, beginning in April, I know JP Morgan is going to begin converting just under $10 billion in mutual funds into ETFs. We had Gerard O'Reilly and the team on from Dimensional Funds last year when they did that conversion. They were a leader in doing that. Why are you doing this now? And is there some kind of tipping point? I keep waiting for this to happen where this small group of funds converting to ETFs eventually turns into a flood for the whole industry.
Yeah, well, we think the announcement that we made around converting 4 mutual funds to ETFs is great for investors. As we talked about at the top, you know, the benefit of the ETF wrapper combined with these strategies, we think makes a very attractive proposition. We are lowering the fees on all of the strategies that we've announced that we're going to do that on. So, you know, that's something that we're excited about, and we're going to convert those 4 mutual funds into ETFs. As far as a tipping point, I don't think so. You know, speaking for JP Morgan, we've got $800 billion in our mutual fund franchise. We're very successful in that space. We know that investors use mutual funds across their entire book of business. That plays an important role in the ecosystem as well. So I don't think it's an either or. I think it's a both conversation. We do know that, you know, the ETF space is growing rapidly. We know that investors are starting to incorporate more and more ETFs into their portfolios, but they're also using mutual funds, and those get the job done as well.
Dave, Brian was speaking like a guy who not only runs ETFs, but has a firm that has a lot of mutual funds, too. Let me throw it to you. When will it be? We keep waiting for this to happen. Well, you know where my bread's buttered on this. When will it become a flood?
We're in the middle of the flood. You just can't tell because the water's rising a little bit slower than you were expecting. You're not seeing the wave come down the wall. I mean, we had Capital Group just announce, yesterday or the day before, that they've licensed Fidelity's non-transparent active system for their conversion and bringing new product to market. So look, we're going to see every major active and passive asset manager in the ETF space. Some of them will convert mutual funds where it makes sense. Some of them, like, say, Fidelity, is going to have to launch clone funds like they did with Magellan because Magellan is sitting in too many 401k plans. It makes it too complicated. So all of this money will eventually show up in the ETF space, but whether it's converted or not is largely irrelevant. The point is the active managers are here. They're coming even faster than we expected, and I suspect this is going to be a big year for active flows.
Okay, that's a good point. Now, Brian, let's move on. Thematic stuff, sustainable stuff. Still a big trend in 2022. We beat it to death in ESG in 2019 and 2020, but it's still there. You just launched the JP Morgan Climate Change Solution, TEMP, like that, TEMP. It's an actively managed ETF around climate change. How is this set up? How do you do active management on climate change?
Yeah, so this is designed with data and refined by research is what we like to say there. So we're taking our proprietary artificial intelligence and machine learning process to evaluate millions of different data points across 13,000 different securities to establish a starting basket of companies that could potentially benefit from the different climate change solutions and trends that'll emerge on the back of that. And then we're refining it by research. And so our active analysts are doing fundamental research on every single one of the names and deciding which of those names deserves a spot within the portfolio. And so we think we're combining the best of both worlds. The macro story there is huge. We estimate there needs to be $140 trillion investment in energy and global infrastructure in order to get to some of the net zero targets that many of the countries and regions are talking about by 2050. So $140 trillion of investment. These companies are the companies that are working on those solutions right now. And so we're really excited about that. It's the first active climate change solution strategy to come out in an ETF. Ticker TEMP is also a nod towards the temperature as well.
Well, when I look at this list here, the top holdings, Deere, Eaton, Trane, Johnson Controls, these are global industrials, essentially. To what extent are they actually truly participating in climate change solutions? I guess I have no problem with the idea that these companies are very involved in affecting the climate. How are they involved in climate change solutions, I guess?
Yeah, I think that's the point. I think one of the things that we've observed is that climate change affects all different industries. It's not just we need to move from natural resources to solar or renewables or something like that. That certainly plays a big part of it, but it's also in construction. It's also in agriculture. It's also in healthcare and a number of other industries that need to do that. And so that's why we think this is such a nuanced conversation, and that you can't just set up a simple rule that screens for some buzzwords that help us stock it into an index. By having the fundamental research that are evaluating those names that you just mentioned, understanding what it is that they're really trying to accomplish when it comes to climate change, and making sure that they do deserve a spot in that portfolio and that they can affect change there, that's where we think the active management really comes into play.
Yeah, you do understand. I want to get your response there, but you do understand that there are a lot of people. When I bring this up, I get emails from people who say, Bob, those old global industrials used to be part of the problem, not part of the solution, and now it's more nuanced. We have to consider. You get the fundamental problem here. There are people who push back pretty heavily every time we do this kind of thing about that idea. Dave, you want to respond to that? And what you're going to make a point?
Yeah. I think you're actually right on the money here, right? ESG, climate change investing, whatever, sustainability, it exists on a spectrum, right? And obviously, all the way at one end of the spectrum, you have companies that are only making a direct impact, and that is their entire reason for existing. all the way on the other, you have companies that have broad ranges of business that are actually changing how they do business to respond to what's going on in climate change. And reasonable people can disagree about whether it's smart to invest on one end of those spectrums or not. What Brian's talking about here, and what a lot of the net zero type solutions we've seen launched in the last year are talking about, is looking at the global economy from the perspective of what does it look like in a net zero world. It doesn't mean that you no longer manufacture chemicals and no longer put rubber on your car. It means that how you do those things and the impact of those things is going to change. So it doesn't surprise me at all to see a bunch of global industrials on the list there. I think that's actually the right approach when you're trying to think about the global climate change problem. You just have to recognize that's very different than buying a solar energy company. They're different kinds of investing for different purposes. What Brian's talking about is actually where the institutional market is very strongly headed. 40 billion in flows into ESG ETFs last year. It's a trend that's going to keep continuing.
Dave, Brian, you anything you want to say about? I think Dave had a very good response there. They were part of the problem, and now they're getting more nuance. You used the word nuance. I'm reflecting what you said, but you understand. I get the emails from people who still don't quite understand how is this part of the global solution?
Yeah, I think that's right, and I would agree with everything that Dave just said. But I think the other thing when we were designing this ETF is we wanted it to be durable. We wanted this to be something that could play a role in portfolios for the long term. We didn't want this to be a market timing thing where I'm in this week, out next week. Because of certain things that got tweeted out, or what we're seeing in some of the trendy spaces around some of these other areas. We wanted it to be durable and have a lasting place in portfolios. And as a fiduciary, that's how we're kind of thinking about that. So I definitely understand some of those names have kind of that nature to them. But that's how we designed this with intentionality in mind.
Yeah. Dave, I want to just switch subjects for a minute, and something that's very topical here that I'll be dealing with in the next hour. We've got a Fed meeting coming up in another hour. I know you're not an economist, but how does the Fed decision factor into ETF holdings? It seems like everything the last month we've been dealing with essentially has got the Fed's fingerprints on it right now. Any thoughts on what may happen with the ETF community around the Fed?
I mean, this feels like one of the most forecast and broadcast Fed meetings I think I've ever seen. Obviously, there's going to be a lot of nuance, and that nuance is going to be really important. But in terms of what's going on inside ETFs, no, this doesn't make that much a difference. Most financial advisors are well positioned already going into this. They're not going to be surprised almost regardless of what happens out of this one meeting. I think the bigger issue is there some sort of relief rally that comes out of this, or is there just a bunch of rearranging that goes on based on what comes out of this? These kinds of earnings running into a Fed meeting is probably the most uncertain the market ever is. So I think most investors just want to get past this and get to Monday next week.
I completely agree. I sat and watched Microsoft's trading after hours after their earnings release yesterday.
Insanity.
And it moved. It was truly breathtaking. It went from after the earnings release down 5%. Then the conference call where they clarified and gave guidance, it went to up 5%. The second biggest stock in the United States, a $2 trillion market cap, moved 10% in 2 hours. And when I pointed this out to people, they said, well, there's a lot of bot trading around the headlines. And I said, no, that's pretty breathtaking. And that shows you how crazy and weird and jittery the market is, and also highlights that people ought to be very, very careful trading in the after hours, which is the obvious.
It's a great week to take a vacation and come back Monday and look at your portfolio. I think that's actually the best investment advice I could give.
Yeah, well, and don't trade in the after hours.
Don't trade at 5:30 when you're waiting for a conference call. Yeah.
Yeah, really, seriously. All right, guys, we're going to have to leave it there. Thank you very much. This has been a great discussion. Two of my favorite people in the whole business. And that does it, folks, for this week's ETF Edge. My thanks to Brian and Dave. We've asked Dave to stick around and chat with us on the ETF Edge podcast and talk about a new report that says the creators of indexes need to be more transparent in how they create indexes and what goes in them. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody, have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the Etf Edge Newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds. Expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/Etf Edge Newsletter.